Hey everybody, we are going to be going over the Huntsville, Gulfport, and a little bit of the Houston properties. This is our annual report. We've never done one of these before, so I don't really know what to expect, but we really want to try and knock this out in the next hour, but at least give you guys a little bit of a forum to ask specific questions about what deals you guys are in and hear a little bit insights from other deals so we don't have 9 different meetings going on. A little bit of the agenda. We'll run through each of the deals pretty quickly. If you guys have any specific question on a deal, type it into the question and answer box and let us know which deal you're referring to. But the first thing we want to go over is like the Huntsville ones, then the Gulfport ones, and then the Houston ones in that order. But the first thing we want to take care of, we've got some full cycle deals. Wedgwood and Tree Haven, for those of you guys, the earlier investors, 3 years ago almost. Thank you for jumping on the bandwagon earlier. We are exiting those deals for a nice little return there. These were Class C deals. They gave us, I would say Wedgwood is one of the more rougher areas. That one we had some pretty shady characters walking around in the beginning. That was a 49 unit. Originally projected return was 160% in 8 years. I honestly don't even know how we sold this deal. 8 years is a long time horizon. The deals have gotten a lot stronger, especially lately. But here is the breakdown for Wedgwood and Tree Haven. Wedgwood's on the right, Tree Haven's on the left. So you have the offer, and then we have all these cash reserves that we have. Then we minus out the debt, and then it goes through the 80-20 split and out to you guys. Looks like you guys might end up with somewhere about a 30% return in 2.5 years about. I know we closed Wedgwood a lot later than Tree Haven. And for those of you guys don't recall, or Wedgwood was that property that it took us forever to close and the seller let the property go. So we inherited this property at 50-60%, and it's been a grind to get this one back. Tree Haven was pretty nice and stabilized. And this one, we bought it at 27 a door, Kyle, and then now it's going at 42. So that one's going to have a bigger pop there. I think these numbers are a little bit lower than what we're actually selling it at, but it looks like it's to be around a 50% return on investment for passives there. And then also I've got 140 unit in Atlanta. We are closing on that. Hopefully we're going to push it till next year just so we don't make that income come on the K1 for 2020. We're going to push it to the K1 2021. 2.5 years on ownership there. We're more than doubling investor money on that one. That's probably gonna be like a 50-60% annualized return per year. Another Class C deal. I think that was just a part of it is just getting lucky. The cap rates came down, and you guys hear us talking about all the time where we increase the reversing cap. That's to be conservative, but sometimes cap rates can come down, which I actually am a little optimistic that we might see that this next year and do some nice refinances on some of these deals that we're going to be talking about today. But yeah, part of that big pop was just cap rates coming down, and that's the multiplier for our sale price. And then Kyle, you want to talk about the Chattanooga deal?
Sure. Yeah, this one we bought in early 2017, ended up being a much heavier value add than we anticipated. Similar to what Lane was saying, when we took over Wedgwood, we inherited, and it was 50-60% occupancy. That was a very similar story to this one, but we were able to renovate units pretty quickly there, and we were getting year 3 projected rents upon those renovations. We ended up selling that just in August is when we closed for a nice return around 32% average annualized returns. We had some pretty happy investors there as well, but it definitely took much more effort than we anticipated in renovating those units and turning that property around.
Yeah, so just to conceptualize this average annualized return, this is per year. Normally we're saying doubling your money in 5 years. That's 100% return in 5 years. So that's 20% a year. We're beating that here. And as you're seeing, there's like a cone of uncertainty, right? It's a range. I think in the beginning, a lot of investors are like, you guys said it was going to be 6.8% cash flow for the first year, and maybe it turns out to be 5.2 or 7.5. That's just how these deals are. I think it's nice to see that these deals all outperform, but there's some risk involved, and sometimes it can come to the good side for us, like it has. So yeah, we'll go through the deals. We'll start out with, we talked about Wedgewood, we talked about Garden Place, Tree Haven. Those are the initial Class C deals, and then we started to pick up more Class B assets. Silverstone was the next property. I have these tables here that go month or week to week, and the thing I would probably just highlight on here is look at the occupancy of the property as the timeline horizon changes. This Silverstone property, for some reason, we couldn't get this thing off 100%, which sounds good, but sometimes it slows down rehabs. But this was probably our highest occupancy property. Eventually, we got people to move out around August of this past year, but for the first half of the year, it's pretty strong all through COVID. But I don't know if there's any questions about Silverstone. Type it in now. Any exceptions there? You want to point on that one?
Just at a high level, nothing, no major exceptions. We're really staying in line with the business plan and what we had initially anticipated. Like you said, we got a little bit slower start just because of the occupancy being so high. But the good part about it is we are able to, on the renewals, we're still able to get the rent increases that we projected. So we're really not having to spend a ton of money on renovations on the renewals, and we're getting a nice little pop on those renewals too. That is helping. But property is very stabilized. One of the major CapEx items that we're about to do, just because of just COVID and a backlog of materials and things like that, we're trying to get a fence installed, but we're using a vinyl fence, and it's going to really make it pop in the area. It's also going to provide a little bit of separation from some properties next door, because there's not an existing fence. There's not even a chain link fence. So there's just a lot of foot traffic in and out on the side of the property. So we want to close that off. And at the same time, it's going to look really nice when that gets installed. So we're excited about that. I was on site last week. I was in Huntsville last week. I will add that. Property looked very clean. We got the paint was done on the exterior, and we did the trim. We redid some of the exterior doors, and it looks very clean. It looks like a really nice place to live.
There's a question that came in here from Glenn. To whom were the properties typically sold, institutional or smaller groups? So the assets that we sold here, you got to realize that these are on the lower end, Class C, and they're smaller properties. So generally, these properties go to smaller groups, not the institutional buyers. Those not quite mom and pop buyers, smaller groups. The buyers that are going to be looking to buy once we restabilize, like Brookridge, Imperial Gardens, Whispering Oaks, those types are going to be more of that institutional type. But thus far, no institutional buyers for the current Class C smaller properties yet, which makes sense. And they've been driving Kyle a little crazy, those smaller buyers, which is why we get such good deals, because people like working with us because we don't jerk people around. Brokers bring us properties because we do what we say we're going to do, and we don't give them a hard time. Okay, moving on to Brookridge. This is the Class B in Huntsville, 171 unit. Really the tail on this one, occupancy has really stayed the same. And maybe I'll at the end, we'll compare all the properties in terms of what happened through COVID, March through July, just so people can see. But Brookridge has been pretty smooth there. Any comments on that one? Let me see.
The only other thing to add is that we're really getting ramped up on some of the CapEx, especially the properties that we acquired in 2020. And Brookridge, we acquired right before COVID hit, and Harbor Village, we acquired right when it hit. Imperial and Chase Creek came to follow that. But what it did do is it delayed some of the CapEx items, just because of what I was mentioning earlier with Silverstone. There was just a major backlog on materials and just contractors in general. A lot of people were staying home, so they were doing a lot of renovations on their own in their own residences. So that put a backlog on just the labor pool in general. So we're starting to get ramped up on some of the major CapEx items for Brookridge. So like replacing some of the staircases on the exterior, the balconies. We did we've done some minor things around, we added new signs. We should be getting the new pool fence installed later in January, not later this month. So in about 30 days, we should be able to get that finished, which will really change the whole look of the property, because that's a major center point of this property. It's right there in the middle of the property. It'll really dress it up, make it look nicer. We're also adding a dog park in there. And so some of these other things have just been delayed up to this point because of that. And so you also factored the labor pool was dried up a little bit, but we didn't want to spend a bunch of CapEx too going into it. And so we're still being very strategic about which projects we are going to move forward with. But so that was part of it too. We wanted to just withhold some of that and just monitor the whole COVID impact of the situation this year.
And then we're going to get a little bit better. We got to redefine the rehabs renovated tracker we have on a lot of our deals. I think right now it's taking the assumption that the rehabs are taken up to that highest level, but we've started to find that we don't really need to take it up to that highest level to get our pro forma rents, which is awesome. But we got to 2021, we got to define that number a little bit better, because then the rehabs are more progressed than this 39 out of 171 units. Brought this upon ourselves. I was like, we got to keep some tracker from investors, but most deals, sponsors don't even do this stuff. We'll get better at that and redefine it so people stay more engaged into what's going on and see progress on that front. Harbor Village, I think this one is probably the one that's seen the highest rent bumps, and we thought this going in.
Yeah, we are on average at Harbor Village seeing about $200 to $250 rent increases, and which is what we saw, but we did not feel comfortable putting that into our actual projections. But that is coming true. And so, and we're really not having an issue. We're not having to hold out. It's not taking extended amount of time to find the right tenants that are willing to pay that. It's just a sign of that specific property being so under market in rents. And so that's where a lot of that upside is coming in. So it's great. It's great. And on that one too, it's been a mix. Some of the units we've had to do heavier renovations just because we bought it straight from the developer, developed this property back in the early 80s, and we bought it directly from him. So he hadn't done a ton of interior cosmetic stuff. He's kept up with the deferred maintenance and stuff like that. So that helped us out. But as far as the aesthetics and everything else, what's in style these days compared to the market properties, he hadn't really stayed up to date with that. So that's what we're doing. We're doing the grays and the whites just like we typically do in a lot of the other properties, and it's really resonating well. The existing residents that we inherited, they can see we're making massive changes and great improvements there too. So they are also signing their renewals at no problem, and usually higher rates too. We're still pushing. We really haven't settled on anything as far as, okay, this is our average price. This is what we're going to market every time we go out. Because right now we're just, every time we get a unit available, we're just trying to push it as high as we can. And so far we've been able to get that, but it's progressing well. We like where we stand with Harbor Village.
Yeah, I was just trying to calculate a little bit on how much we're exceeding market sale there. So for $50 higher than our pro forma at 100 units, assuming this trend continues, that's $60,000 of NOI extra a year, multiplied by, I don't know, 7 cap. I think that's conservative. And that's $850,000 better than what we thought. And I think, what was the capital raise for this? Like $1.5 million, $2 million or something like that?
2 million-ish, okay, roughly in there.
That's almost an extra 30% overall.
Yeah.
So things are going good on Harbor Village. Imperial Gardens, that one got picked up pretty recently, so we don't have that run record thus far on that.
Yep, we closed on that officially at the end of October, but during COVID, it exceeded expectations, as similar to some of these other properties. And just in the couple months that we've owned it, property has continued to increase collections. So things are looking good there. We do have quite a bit more work to do than we initially anticipated, as far as CapEx goes, but it's definitely nothing that we can't handle. And the thing I love about most is this property's location within Huntsville. It's actually in a better area than really any of these other properties that we own, and it's in a I would say, more growing area. Huntsville as a whole is continuing to grow, but I would say this property is just actually located in a little bit better area that is seeing a little bit more growth. And just the proximity to downtown and the hospital and a lot of other jobs is superior. So very excited about that one and what will come to fruition in 2021.
And the Chase Creek development, moving dirt, very nice to see that before the end of the year. And we haven't yet signed that GMP contract yet, but that is any day now.
We just gave the okay on that. So we are literally replacing the number itself. And what that is, the GMP is, that's the guaranteed max price contract that we sign with the general contractor, which basically says the price to build will not exceed this price. We finally approved that specific number. So all the language of the contract is actually worked out and everything else. So literally I've even seen some emails this morning with the contractor. So we should have that signed by the end of this week. But as Lane mentioned, we already went ahead and we did a side agreement outside of that with the site work so that we could start the process, because now's the time to get it done, or to start the construction, to be able to hit some of our timelines that we want to hit. Looks good. It's just it looks like the dirt has just moved around and not much to look at yet, but there's a lot of prep work that goes into that. So hopefully they should start pouring slabs here in a couple weeks, which then you'll really start to see the layout of the property take shape. But really excited about that one too. And just a little teaser, we did put it under contract, another 25 acres at some point. Not at some point. We put it under contract, the 25 acres. At some point, we will probably put something together on that. So stay tuned. At some point in 2021, that should show its face.
And we also had a question, what info do you have on the adjacent complex under construction? I think reading too much into that adjacent complex, I'm not too concerned with it, but I don't know, Kyle, did you get a peek on what's happening?
No, so we know who the developer is. They've developed one other property in the market, and it is one of those properties that it's not a affordable housing type of an asset, like a tax credit. But if you look at the pictures, it looks like it already needs renovations, and this property is only 5 years old. They just went really low grade on their finishes and everything else. From what we can tell, that's just kind of how this developer builds these properties. I did some more homework and just some other markets that they build in, and all those properties look the same. So that's why Elaine says that once, obviously time will tell and what they actually put to market, but there's a really good chance that we'll also be leasing up before they finish leasing up, or probably even at least before they complete their entire property. We should be done, because they're pretty far behind from what it looks like. They've got some structures in place on the framing. It looks like they've got a clubhouse and maybe a couple garages, but that's about it. They've been in the same state since Lane and I first visited the property back in March. So they might have had some issues this year, just continuing to pull from the labor pool that is available to them. Yeah, but we're really excited about that property. There's other things going in there. Obviously, there's a big residential development happening there called Trailhead. That's going to bring in a lot more need to bring in other things that would service our community, like just commercial retail, grocery stores, things like that. That area is definitely growing. There's a lot of dirt being moved around in that little area. And right now it's just us and that other apartment complex that are the only multifamilies that have been permitted.
Yeah, and we have all our capital raised ready to go on that project. It's not, I think most developers, they raise it as it goes along. So that's why we can move a little bit faster than these guys, the bigger institutions.
Exactly. Yep.
Before we wrap up Huntsville, we had a question here on Wedgwood. Someone's asking, not that 13% is a bad return by any means, but anything you guys learned that the deal that you used to go moving forward, or the other 2018 deal starts, which had more upside? I'll let you answer this too, but Kyle, but I guess like the way I was looking at Wedgwood, if you guys recall, we put this deal out in 160% in 8 years, which is still 20%, but this is a little syndicator trick. You just, if the deal isn't as strong, you extend out the time, because these deals, they don't progress. So the returns go up like a hockey stick. The longer you hold out, 8 years, the more stronger the returns are going to be. That's why we try to make it consistent at 5 year sale. The fact that this one, we cut this one short, obviously, it wasn't like a full goal. But to be honest, when I was telling the guys in these deals, is I feel way more confident growing their money and much more safer in the newer deals like Cambridge than to keep them in this. And that's ultimately what it's all about. It's just reshuffling the deck and putting him into a different deal where I think it's a lot better return potential and a lot safer.
Yeah, I will add, which is something that maybe a lot of limited partners don't really see, is that this was an earlier deal that Lane and I did with another set of partners too, which also had influence on why we decided to sell it earlier too. So that was going on too. Lane and I have obviously broken off since then, but one of the big things is just the way that our underwriting has changed. Obviously, that has learning from those experiences has given us more confidence in some cases, but also just things to look out for during due diligence, specifically adding contingencies to the budget and things like that, which we've done and we've incorporated in all the deals that we have already mentioned so far. It's just things like that we're always refining, and especially on the due diligence, that's something that we're always, it seems every deal we're adding at least something or tweaking something a little bit to our underwriting to make sure that we're accounting for that.
Yeah, always lessons learned on those. Yeah, moving over to the Gulfport, Mississippi deals, or
we've got a couple more questions I was going to address that are specific to Chase Creek.
Where did these all come from?
I scrolled down, but they're all somewhat related, so it's good to talk about it. The first one is, how are lumber and other material prices having a significant impact on the pro forma for Chase Creek? Right now, if we decided to order lumber today, it would have a very significant impact. What we're doing is, because of just where the pricing of lumber is specifically, it's really just lumber. The other materials that we're seeing, it's not so much a pricing issue, it's just a back ordered issue, especially when we're talking about appliances. But as far as all the other materials that we're going to need, everything's pretty much in line with our pro forma. It's just lumber that's just acting really crazy right now. It's so volatile. What we're doing is we're just holding off on purchasing any lumber yet. So we're hoping that it's pretty high right now. In fact, it's been higher in the last couple of weeks than it was even in the height of the spike. The good thing is we own the land. We're in a position where we can hold off if we have to. Obviously, we would have to work with the lender, but we have extensions built in with our loan to allow for that. The best case scenario is that obviously lumber comes down at a price that's within a small percentage of where our pro forma is, but we're going to wait and see. And we don't need to actually order our lumber until probably mid to late February at this point, if everything stays on track. So we still have some time to wait and see how that shakes out. So I'm optimistic, just because this is a time where, if you look at it, it seems like lumber pricing does come up a little bit towards the end of the year, but we'll see. I don't think anybody predicted that. So just chalk it up to the year 2020 and everybody else's predictions.
And we don't have to buy it all in one go. There's kind of like a three tranche deal with the lumber. So if things are playing around.
Yeah.
And this is where we work with
we've got some flexibility.
The contractors has a little bit more insights into pricing, and they, as the GMP, that's their take on that risk, and they need to use their brain and when they need to order it at the optimal time.
Right.
Too. I had an idea on a past construction project where we would go and buy the steel girders for a bridge as an owner at risk, but we decided to leave it in the GMP on the contractor side for them to burden that pricing risk at this point.
Yeah. A couple questions on the actual GMP. So as far as just being happy with the outcome, I think we are generally happy with where we're at. It's just, it goes back to the uncertainty, the way we had to structure the language around lumber, because the subs are not really willing to guarantee that longer than 2 weeks right now. So that is a real life scenario that we're dealing with. So that pricing is not going to hold, even if we get that back, we sign it today. So we've had to loosen the language a little bit right there. But as far as just the cost assumptions within the GMP, we're slightly higher than where the actual budget is. But I think that's mostly by design anyways, because the contractor is essentially on the hook for this once they sign their name to it. So they're going to add in a little bit more fluff than probably exactly what they're showing us is what we're seeing. And we, in so many words, without them actually admitting that, know that's going on. But we've really stripped this down. Our other partner in this deal, Greg, he's not on the call, but he's done a great job and really just hammering the contractor and making sure that everything is in line with the market and that they're just going to be fully transparent through the process, which they are. I think what they're doing is they're giving themselves some room because they're not going to be able to hide anything the way that we have this structured. They have to provide actual invoices from the subs. So this isn't like they put their name on an invoice and then they send it to us. They have to show full transparency so we see their cost, because this is a cost plus type of engagement, meaning they put their fee on top of the actual hard cost. So they're charging us 5% of the actual hard cost, that's right in line with the market. But part of that is they have to be fully transparent with where they end up. So those are just some other checks and balances that we've implemented that we're going to be able to see that. So even if they factored in a little bit of contingency by just what they are willing to commit to in the GMP, but I still, just from talking to them and having multiple discussions around the topic in general, and the way that we've structured the GMP to even incorporate a savings split where they get incentivized and they get a bonus if they come in under budget. So we put some good incentives in place for them to do that. So we are overall, we're happy with where this is going to end up.
And it's not super simple, just the GMP. It's also the loan to the bank. The bank is essentially giving us the loan for the project. So there's some kind of, it kind of cushions that a little bit there too. And then there are also measures come down the road for us to engineer out certain things to lower costs. And we still are carrying several $1 million of contingency at this point.
Yeah, that's right. We have our own contingency as well that we haven't even tapped into. That's not even going to be a part of that GMP. So that's a good point. So.
Yeah, we make sure we don't tell the contractor that.
I see another question. There's a question from Chris asking about 21. I think we'll probably save that one for the end. But There's another one on Chase Creek that says, are we planning to finish up the garden style structures in phases to start lease ups of the units in series while the rest of the structures are getting the finishes put on, or finish all the lease up? Yes. So yeah, we are going to, the way it looks like, we have 10 total buildings, and then we have a clubhouse plus a maintenance shed. So there's 12 structures that I think will have to be framed out. So the clubhouse, the maintenance shed, and then the first two buildings is the order of how they'll be framed out. So yeah, they're gonna basically punch it out in phases. They'll be doing everything in tandem, but as far as lease ups go, we will punch out two at a time. And right now it's loose, but we're looking at the Q4 of 2021 before we start leasing up, because we'll start leasing up 60-90 days out before we actually anticipate getting our certificate of occupancy. So probably at least 3 full months, because people know that they're going to know whether or not they want to move at that point, or if they're moving into the area. So it'll be a good time to start lease up at least three months out.
Yeah, with the clubhouse being on the front half of that, because that's critical for leasing. And then with all the other units being pretty ubiquitous, that those will be put in at the end. Seems like we got more questions about projects from investors that aren't even in those deals. Gulfport. So let's moving on to Gulfport, Mississippi. This is in the area of Biloxi. These were purchased, 2018? And one beginning of 2019.
Southern Pines was the beginning of 19.
Yeah, so 101 units. This one we ran into, if you guys were talking about a little bit of lessons learned, I think I do have this on the website as one of the big lessons learned. And because it's such a smaller property, things like this really put a booger in the budget. There was a little bit of a sinkage. I don't want to use the word sinkhole because people go crazy over that word, but it caused a little crack in the pool, and it's a rather larger repair, under 50 grand on that magnitude, over 10. If you think about like that, something like that on a smaller property like that will definitely drain your cash reserves. Probably has been operating pretty well, though. You can see here low to mid 90s, and then when COVID hits, maybe it came down into the 80s, the high 80s, but then after that, it's been pretty consistent around high 80s, low 90s after. And then I think this is the only property we're experiencing a holiday slowdown, which is typical.
Yeah, this one, and we're working to remediate that on these new lease ups because we anticipated that again. We experienced that last year too, and it took us a little bit to get that back into the low to mid 90s. So the way we're structuring the leases now is by trying to do 18-month leases or 14-month leases. So we're really trying to stagger them and get them away from just being heavy end of year leases. So that's why we've seen that. But yeah, overall, like Lane mentioned, we've had a couple snags in just, higher CapEx things that have popped up that we didn't account for. So that goes into, this was an earlier deal that we were underwriting to. It took us some time to actually get through the process and close it, which is why it leaked over into the new year. But this one too, we learned from this going into it that we just needed to, even though we had some contingency allocated, we needed to add even more, especially depending on the vintage of the actual asset. But overall, the collections are good for what we have available to us with the residents that are in occupying the units. The Gulfport Biloxi area is actually still slowly growing. It's not a Huntsville type of a growth story, but Universal just this year, even in the middle of the summer during COVID, they announced that they're going to build a multi-billion-dollar casino in the area. So there's still a lot of attention and draw to coming into this area. It's a nice little tourist area for people who can't get out to Vegas. Vegas is actually hard to get to for a lot of the people in the South. They've got to go through another major city. They've got to connect, whereas Gulfport Biloxi for people in the Southeast is just an easy place to just drive to and get to. And it's on the beach and there's multiple casinos to choose from and they're relatively cheap compared to Vegas. Although obviously this is pre-COVID. We're talking about Vegas is pretty cheap right now if you've priced any rooms lately. But yeah, I think the plan for this is just to continue to stabilize it. This could be one that we'll see how 2021 goes and see where the market takes us. But if we were to, this could be one that we could potentially look at selling as well if we did go down that path. But I hate to commit that and even push that out there because this is a 5 to 6 year business plan. And even though we got off to a slow start, our rents and everything else are tracking right in line with our pro formas.
Yeah, and this was the one property that out of the bunch I was a little worried about because it was in close proximity to the casinos, and you would think that there would be a lot of hotel staff, but wasn't the case, I think.
Well, the casinos actually they continued to pay all of their employees. So the employees who worked at the casinos couldn't even get unemployment through the process because they were being paid. So that's one thing that they decided to do.
And then what Kyle was mentioning, how on the Mississippi assets we decided not to do a cost seg on. Our feeling is once we get a nice little pop, like the other Huntsville Class C properties, we'd probably move to sell the assets and get investors their nice little return in a quicker amount of time. Just feel more confident in the Houston and the Huntsville markets in general and the better assets. So investors will ask all the time, how long is the hold? And like, we don't know, but we don't know what the market's going to be in the future. We don't know if there's any potential skeletons in the property, but we're just trying to stay fluid and react and grow people's money the best we can and do rehabs and take what the market gives us. So moving on to Magnolia Gardens, 80 unit, very similar property to Southern Pines. We did not have that little pool snag there. So this one's been pretty much stabilized and cash flowing, no problem. Just kind of scrolling down a little bit, you guys can see the column F there, the occupancy pretty much staying.
Yeah, this one I would compare it to how Silverstone was. This one is actually probably slightly better in terms of the occupancy compared to Silverstone. So this one could be up for debate which property is higher on the occupancy throughout the life of the deal, but which has slowed the process of renovations like we talked about for Silverstone. But the good thing is you can see if you go through and you track the collections in the column there, you can see that our gross rents are continuing to increase as well. On the units that are coming available, we're able to come in and do our renovation package that we wanted to do initially and get the increased rents. And on renewals, we're getting the increased rents as well. We've been able to do some CapEx items here. This property needed some pretty heavy tree trimming done. So we spent well, it was like $15,000 in total on that to do the tree trimming. We've done some other things. Of course, we've done the power washing and the mulch. That's like the thing that we always do on a lot of these properties that really doesn't break the bank, and it really just brings new life into the property right away. There is a drainage problem, although we knew about it going into it, but there is in the parking lot in the front part of the property, there's a small area that tends to back up when it rains. So it's just purely a drainage thing. It's not an active leak or anything like that. It's just a drainage thing where we need to go in, and there is a part of the concrete that they're going to have to go in and take a jackhammer to and just repave that, put some new asphalt down. That one, but it's not a major project in terms of CapEx. It's about $5,000 to $6,000 of work with what we're talking about. But and we've approved that. So that should actually start after the first of the year. And then I think just in terms of strategy, like Lane was saying, I know Chris does have a question about Magnolia. If we're thinking that we'll take this all the way to the or I think this one was actually a 6-year hold period. As Lane was mentioning for this particular asset in Southern Pines, we're just constantly assessing. We're not in a hurry. We're not in a desperate situation where we need to unload any of these assets. It's just a matter of where do we want to strategically allocate our time and spend the efforts. But Gulfport, like I said, it's seeing growth. As a market, we're continuing to see growth in our rents and our revenue. And Magnolia is cash flowing, and we're doing distributions there too. And I think this is a property that's right on track with all of our distributions, right in line with pro forma too. So things are going well here.
Yeah. So maybe if I were to take a look into the crystal ball on the Mississippi properties, maybe we'd like to get up to 70-80% of the rehab. So maybe that's a couple more years to really, cash that one in. I don't know if the 180 units is quite big enough to package up to sell to an institutional buyer. That would be nice, but maybe we might get there. You never know. I think at some point you just leave this up on to brokers and have them kick it around.
Yep.
So moving on to the Houston stuff. So recently picked up Whispering Oaks. This really got us ins with the broker out there, which brought us Cambridge, and future deal flow looks pretty bright.
Yeah.
Question here. So the Mitchell Company is our property management company. Sometimes we refer them to TMC, which confuses me. It looks like TMZ, but we brought them. They started working with us in Magnolia and Southern Pines and Gulfport. We brought them to Huntsville on all those assets, and now we're bringing them over to Houston because of our good working relationship. They're based out of Mobile, Alabama. They're more of a regional property manager, so they're in the southern region. Can you elaborate on Mitchell Company and how they plan to manage the Huntsville and Houston portfolio they have?
So if you think about it, there are lots of nationwide property management companies. They have headquarters that are generally not always in the same areas, the properties that they manage. How they structure it is they just assign a regional, or if they have more units, they will actually hire a regional in the actual market itself. So right now, up to this point, they've just had a regional that we use who's assigned, and she is based in Mobile, but she's in Huntsville. There's 3 people who are actively going out to each property in between Huntsville and Houston. It's the regional, it's their construction manager, and it's the VP. And so between those 3 people, they're touching these properties at a minimum every week and a half to 2 weeks at the longest. So that's how they come in. So they're staying on top of the projects. They're very much involved in that. Huntsville will probably get a regional manager at some point in 2021. I know that's something that we talked about when we launched the Huntsville 3-pack. And so now it's coming to fruition. So I do anticipate in 2021, Huntsville may get a regional from TMC, which will help us too, because we've got a lot of other stuff going on. And Houston's not far behind. We've got Whispering Oaks. We've got that we closed on. We've got Cambridge that we just launched, and we just started the capital raise on that. We actually have another property that's on going through the contract negotiation process now that will probably launch, I don't know, February, March timeframe, just depends. So we've got a lot of activity here locally. Of course, I'm based in Houston, but from the property management side, that's how they structure that. And really any management company handles it the same way. It's just about what they have in close proximity. The reason why we wanted to use them versus just hiring one of the bigger corporations here in Houston is just they really understand our vision. We've spent so much time with them. They understand exactly what we need as far as financials for our reporting, how we want it to come across, the types of, just even down to the journal entries. We've had that level of detailed conversations as far as accounting. They know my accountants. They know everybody, the folks at Baker Tilly. So there's a relationship there. So there's just really a good team in place. They know our attorney. They know Dugan. They're just really involved in what we do. But more than that, they're really good at what they do. They really take heart to representing us. They understand our vision for the properties as well. And it's easier to replicate something because you can make reference to something like, oh, Chris, I want this unit at Whispering Oaks to look like the one we just did at Harbor Village. Just use that as your model, and he's done. And they can go in and they can price it that way. They at least know that our aesthetically and cosmetically what we like to. But probably the single biggest driver that I love about Mitchell Company is I have not met, and I'm not a contractor. I'm not the one actually doing hands-on stuff, but I've done had a lot of experience in managing contractors. I used to flip houses before I got into multifamily anyways. I've never met somebody who knows construction better than Chris Sylvester and Daryl Gaston from the Mitchell Company. Those guys are so knowledgeable. I trust them. They represent us very well. They do all of our inspections, and they come from the developer background too. So the Mitchell Company used to develop a lot of properties. They developed over 150 multifamily properties. They don't develop multifamily more. They still develop some like single tenant commercial retail stuff, but they just know construction through, and they know how to do it. And the biggest part of that, I know I can trust them.
And just to give a little bit insight on how the Mitchell Company set up, Kyle's mentioning Chris Sylvester. He's the VP. We're lucky enough to have that dialogue directly with the VP. Again, we're looking to implement the regionals in there. I don't know how much money they get paid. Maybe they're like a $100,000 a year employee with some incentives, but they are the ones who oversee the people sitting in at the leasing office, your $50,000 employee. Initially, when we started out, kind of our direct line of communication was with Chris and then that person at the desk. So the regionals really help take a load off us in terms of managing them. And those $50,000 employees, they need some back-end support too. So that's what the Mitchell Company provides them, the systems and processes. And from what I've seen, this is all within the Mitchell Company's HR department, how they wanted to run their show, but they usually absorb the existing property manager if they're good. You can tell when you're out there for an hour.
Yeah, exactly. We've got a question from Logan. How much of the percentage of their portfolio are from our properties? That is a good question. I'll actually ask and get an exact, but my rough calculation tells me it's probably anywhere between 15 to 18%, somewhere in there. So it's not small, but we're definitely not the only ones. But one thing that we are talking about, and this is something that is actually a live conversation, is we're essentially getting our own team. So they have, what will likely happen is just have somebody who works directly for Chris. Obviously, Chris is going to be very involved in that, but have somebody that works directly for Chris just be assigned to our portfolio to work with the regionals more closely. So that they will only be dedicated to our portfolio instead of just having somebody be bouncing between Huntsville and Houston and Gulfport. So that's something that I'm excited about.
Yeah, we're also doing that as a strategic play so that we use their HR department, we use their payroll, and if there's any kind of labor issues, lawsuits, they sue their employer, the Mitchell Company, instead of us. But
I did want to, we've got a question on Whispering Oaks as well that I noticed that it came in earlier. from Anthony. How did it look at closing? Any surprises, positives, negatives? When can we expect first distributions? And what will that include and thereafter? To answer the last question first on distributions, generally we say give us 6 months before we make the first distribution, but then at the same time, we also try to time it to be in line with the calendar quarters. It just makes it a lot easier to manage that way instead of having multiple property, 12, 15 properties, and each has a different distribution schedule. So I think the first distribution for the Class A2s could probably be as early as March. And then for the Class A1s, we're going to try to see if we can get those out and start those in January. And typically for the equity side of our investors, it includes a whole quarter's worth of distributions. I think on this one, for Whispering Oaks, we did Class A1s will get paid out monthly. So that's what that'll look like. Closing was smooth. This was actually one of the smoothest closings I've ever had. So everything was good. The lender was on point. No real surprises other than a week after we closed, we did have a unit that had a fire in it. So it was contained to the unit. There was some damage there. So we're going to have to actually go in and completely gut that. But that's part of what we have contingency for going into this. So it shouldn't really affect the returns or anything like that out of the gate, but that's something that you can never account for a fire, but you just prepare with a contingency in this matter. Like I said, it was only just the one unit that was damaged. It was just a little kitchen fire that they had. Nobody was hurt, thankfully, but that is something that popped up that was, I would classify that as a negative, but we were prepared for it. So
yeah, usually those fires come out better for investors at the end because we can go in and use that insurance money to pay for revamping the property, making it better than what it was, because that's the type of insurance. The only question is, do we have enough cash reserves, working capital, which we do, which is great, just to last when the insurance payout's going to happen. But if anything, that's just a headache on the asset manager's part. So you guys don't care about that. Okay, we talked about the pref equity investors. Yeah, it's still early to tell on the getting the COVID reserves back yet. We're still in that restabilization period.
Anecdotally, though, they did put some relief on new deals. So on the smaller loans, they were having them, not that this affects anything that we have, but on the smaller loans, it used to be 18 months. They drew that back to 12. So hopefully moving forward, maybe fingers crossed on Cambridge, our reserves will be smaller than the 12 months that we've already anticipated. But like I said, at a higher level, anecdotally, that's a good sign that lenders are easing up on their reserve requirements, because and they're not going to do that if they don't see a common pattern with the entire portfolio across nationwide. So this is including thousands and thousands of units that would allow them to feel comfortable enough to be able to ease up on their reserves. So that's a positive sign for us just financially, but also a positive sign for what's actually happening in the market versus maybe what you might hear with the talking heads in the news.
Yeah, and something like that wouldn't be grandfathered in, and they would ease it up on all their assets that have those COVID reserves, most likely. I think that was all those questions. If you guys have any questions, type it into the answer box. We'll get to yours, Chris, here in a little bit. But what I did want to show people, some of the questions I had, I was just curious, how did things really look in March through July when, March, if you guys recall, that's when this whole pandemic thing started to happen. People were freaked out. I'm just going to slowly go over the deals in that period. You look at Silverstone from March through July, that didn't move one bit. March through July in Brookridge, that didn't budge from 98, 96%. We didn't have Harbor Village yet. Southern Pines, March through July. Maybe it dipped down there in May, June time. But
that was 19, Lane. That was 19. Scroll down a little bit more.
Oh, March, July. So this actually went on. I don't know.
Yeah, I was going to say, don't sell us short, dude.
Yeah.
It actually was very positive.
I know the Huntsville properties overall, the rents went up and the occupancy went up. Goes to show what a great robust asset this stuff is, and very different than what your headlines are showing in the major news markets, which I think are mostly what's happening in the Bay Area or New York or those types of areas. And then Magnolia here, this hasn't really budged from 97, 98% through the pandemic. Now, the other thing I was just wanted to show people is what's the normal wintertime slowdown? We always experience maybe a 3 to 5% decrease in occupancy on average because this is the slow lease up season. People right after Thanksgiving, people stop looking around to move. It's not the time to be moving, and it's a little bit hard to fill units. So, if you start in Magnolia, you see it. We were right at 100%, and it dropped down to the mid 90s in the wintertime. And I'm showing this just so people get a sense of the ebb and flow of the movements. Although you could probably make an argument that this year was very unusual, and then that summer leg hit later, or that summer spurt hit later in the year because people weren't able to move around from March through July. It's been a wonky year. But you can see how we're hovering at 92, 93%, and it goes just a little bit under 90% on Southern Pines. Harbor Village is just, we need to bump those rents up even higher.
I know, that's what I keep saying. We just need to keep pushing. We've got the time. You can see this is a weekly picture. This is about as real time as we can get as far as where occupancy and collections are. But what you can see is that if we're high 90s, that's a strategy, even up to 100%. Put the rent out a little bit higher, allowing ourselves to maybe wait instead of just getting the first person that comes in a week after we put it on the market, which tends to happen. Put it out there a little bit more, allow us to wait to maybe even 3 weeks to have that unit on the market, just to test the waters to see if we can get somebody who would be willing to pay $300 more versus the $200 more type thing. So that's the kind of stuff that we're still playing with on this property. People just keep signing leases at the higher rents.
To me, academically, if you have A, B, C class property on average, I think your occupancy should be around 92%. Of course, this depends on what class and what market. But to me, if you're above there, you should be increasing the rents. If you're below that, you should be easing off the gas on the rents. Investor was asking me this morning on another deal, which is a Class A, brand new building. It used to be at 99% occupied. What's up? That 92%. Part of that is like the winter slowdown, but that's what it should be. 92% is pretty much full occupancy, and just rounding up the bunch. Silverstone didn't really see a winter slowdown either. Talked about that. We took a little poll from you guys, and just in case you guys were wondering what people were talking about, I was asking, well, would you guys rather see more A, B class, the higher end properties with less upside, or would you rather see some of the B, C assets with more upsides? This just gives me an idea where everybody's head's at. I personally like the B and better assets personally, but that by no means what you should do. So more people were looking for more upside in the little older assets or rougher areas. But I don't know, any commentary there, Kyle? What are you personally looking for your own portfolio?
Yeah, personally, A class always sounds nice from a management standpoint, but I do think it comes down to a numbers perspective. And instead of going and buying a high-end A class deal, that's why we're building something that would be more low A, but even geared towards workforce housing. As far as purchasing, just acquiring assets in general, the way that I'm looking at deals that come through is just really about cash flow is ultimately king. Number one, what does that look like going into the deal? Unless it's just like a deal in a market like Huntsville or in a part of Houston that I know really well, where maybe it's just a property that got slaughtered this last year or something else because they just, and the current owner is just not collecting. Maybe there's no cash flow going into it. It would have to be a very specific scenario like that. Obviously, there's a lot of people who purchase deals just like that where they are heavy value adds, but we do a little bit more stabilized type of an asset, unless, like we said, unless it's just something that we have really high confidence in versus just more speculation. I think it's a mix. Yeah, I think it's ideally that high C to B class would be a preference as far as stabilized versus more upside. For me, I'd mix of both, honestly. So I think that's a little bit more diversification in how I look at that.
Yeah, I would say like the Whispering Oaks, since you guys are familiar with that, since we just did, that was more of A class, A, B class, less upside. 45 of those 140 units were already rehabbed. There's only 100 left to go, whereas Cambridge has a lot more upside. Probably put that in the stabilized BC with more upside.
Yeah.
So you can't really, it's like a ballpoint pen. You can't really pinpoint the tip of it. You either got to go to one side or the other. But
Right.
at least you're still on the same planet, I think.
At the same time, you don't want to box yourself in. And I see that happen a lot with especially the well-known players that are doing all the education and all the just teaching people how to syndicate deals and stuff like that, that have these education, like the massive education programs that we're talking about, the huge followings. Yeah, more than anything else. I have to add more context because as I say that, I know Lane and I both have our own podcasts and everything else. So I don't consider us in that bucket. These are the gurus. But what is they box themselves into this specific niche or this specific market, or this is only what we're doing. Whereas Lane and I have always been a little bit more flexible. We've got enough deals under our belt where there's a mix of both. So we know what we like and what we need to look for. And then we work that in with our very experienced team and the Mitchell company and everything else. So that's why I say having both and then being able to just have a little bit more of a loose, flexible strategy. You still have your criteria, you still have everything that's hard set when it comes to numbers and it comes to the financials and everything else. That kind of stuff is a little bit more rigid. I just mean as far as the actual strategy goes and what we're looking for. We're not as boxed in there.
Yeah, I don't think I've ever told you this, Kyle, but sometimes what I'll do is I don't look at pictures first. I just put it into the spreadsheet. And then I'm trying to check, is it going to get 100% return in 5 years using some assumptions that I know about the market, rent increases per year, reversion cap rate, occupancy. Are we hitting that much? Is there enough meat on the bone? And then if you notice, like is this more of a rougher area with more value add, or it seems like it's more of a stabilized yield play, right? That's when I reveal the pictures or the things that I think can mislead somebody by looking at a deal first. Like I look at the numbers first, which for a lot of passive investors, they're unable to do that. But that's the way I look at it first. To answer Chris's question more specifically there, as long as it fits that, as my spreadsheet lights up green, the 80 to 100% return minimum in 5 years, then I'll continue on. Then we'll probably put it under contract. But there's not really many deals that even come close to that, even 20-30% return in 5 years, to be honest.
Yeah, and just to comment on that, because it does feel like Lane and I have worked hard in the broker community to build rapport, which is why we get consistent deal flow. But the amount of deals that we actually look at and talk about that we never release to the market is massive. So it might look and appear and feel like we're constantly pushing deals out, but that's only really a testament to our relationships that we've built up more than anything else. We're not just chasing every single deal. In fact, we'll get pocket listings all the time from brokers, and we're definitely not looking at. One of the first things I look at, I do something similar to Lane, just with an extra step before. I at least will put in the address and see if it's in a location. So I like looking at the location first. I don't really drill into the numbers, the pictures of the property and take a look at that or drill into the rent comps until I know that it's in an actual location that I would want to invest in, at least a decent area. I mean, Huntsville is you don't have to be as careful when it comes to crime. Huntsville is actually overall a very safe city, but obviously Houston's a major metro area. So there are parts of Houston you just don't want to be in. I won't drive in there even during the day in some cases. In fact, we had another property that was presented to us that we turned away just because of that very reason. The numbers looked great, looked like it could have fit everything in our bucket, but it ultimately came down to the location and the crime that surrounded that property. Just on the surface, without getting too specific, we've got, because you asked about the deal flow, Chris, we've got deals in the pipeline now that are more solid than others. I mentioned the 25 acres that we have under contract. I won't mention the other ones that we have under LOI commitment and exactly where, just out of confidentiality reasons, but we've got some LOIs accepted. We have one that is officially under contract, and then, like I said, a couple of LOIs accepted where we're moving into the contract piece. So our early pipeline looks pretty good, and if we continue to close on these properties, that'll just continue to increase our deal flow in these other markets. And then to answer your last question on any markets, I think we like the markets that we're in, but we're also not opposed to something else. something came up across our desk that was in another market. Now, we're not going to just chase each market. I think if we look at where we're at, like in the Huntsville area, what tends to happen is you've got a more regional broker community. So they'll get properties in Chattanooga, Atlanta, Nashville. Those are some markets that I could see if they popped up and there was an opportunity for us to move into a property there. Chattanooga, we've done deals with. I know Atlanta pretty well. Lane's there now with some other partners. So he's already got experience in Atlanta. I'm very familiar with Atlanta. I've spent a lot of time there personally, just in my personal life. I've got family there. And then same thing with Nashville. I think those are some potentials there. We're not actively pushing them and seeking them. I think it's just more if it happens organically, just because we've got a lot of deal flow between Huntsville and Houston and then the surrounding areas right now. I think that's where our primary focus will be. But like I said, there's going to be organic growth that will probably stem from that, just as it has all the previous years we've been partnering up and doing deals.
Yeah, and just for those of you guys don't really understand like how we get deal flow, we get deals from brokers, and these brokers, it's not like the residential world. The commercial brokers actually really work for their money. The other guys constantly hounding sellers. Hey, it's been 3 months of Sulak talk. How's everything is going? They'll bring flowers to little old ladies who own properties, trying to get them to sell. They're doing stuff like that. So pandemic or not, they're always getting deal flow. Let's just call it like the 1% or 0.1% of deals actually really hit that level that we feel confident of doing. So it's a matter of getting up to the top of their list to getting that 1% property. I'd say the pandemic has been really good for me and Kyle because it has taken a lot of players out of the game, a lot of amateurs who quite honestly couldn't raise more than $1 million or $2 million to buy a crappy Class C building. And they are just totally taken out of the game because they don't have the investors like you guys who put in a form and follow through on your commitments. And we appreciate that from you guys. So you guys are all a part of this. You guys allow us to put a very professional and we say what we're going to do because you guys back us up. So therefore, they bring us more deals. I don't know if they buy Kyle lunch or not these days, or if he's still buying, but it's because we close deals like Whispering Oaks so smoothly. And really, there's not too many people buying out there. I think it makes me upset. And I put this in the e-course, like Secrets of Syndicators. This is one of a lot of guys are like, oh, it's a horrible market. We're not buying anything. It's like, dude, yeah, because you just can't, your investors, you don't have any investors now. You don't have any capital to go out and buy the properties. The deals are still out
Or
there.
access to the deals.
Yeah.
I think that's the other part of it too. It's both. I think there's people out there now that are, even as of this week, I've just seen some of the rhetoric posted on the Facebook forums and all the multifamily stuff where these people they're sitting on the sidelines waiting, which all we're doing is we've really refined our criteria. We want to continue to position ourselves to be in front of the broker community, but they're just sitting on the sidelines waiting for all these distressed assets to come on the market. And I could personally tell you, just because we have put some offers out on some properties where we don't even make it to the final round, because even just this year, it's still so competitive. And I feel like there's even more capital on the streets that are coming. And I don't think the competition is going to let up at all. And so the distressed assets that are going to come to market are probably the properties that are in a very tough location on assets that we don't even really want to own anyways. But we may not even get a glimpse at those if we're not actively doing deals, other than just somebody that's just perusing the broker websites or the loop nets and then just occasionally engaging with the broker. So there's some strategy around it too. But at the end of the day, it just comes down to if we're doing the right deals, and it's not just one thing, it's the total package here when we talk about staying in front of the brokers and then making sure that it passes our underwriting, and then ultimately on the execution side, as Lane mentioned, and that's just the support that we get from all you investors.
And we are also getting some interest from large pref equity investors that are looking to take a bigger chunk, which kind of speaks to the deals and our past performance. And I think from your guys' perspective, it's nice to know that these larger institutional players are going to jump on board along with us because they believe in the deal. It's kind of like in the startup community, you get like a celebrity investor on your roster to invest. It's the same thing. They vouch for it.
Glenn asked a quick question if we're looking at any new properties or development stuff in Houston. And so, yes, we are. That is a market we're actively taking a look at and trying to stay in front of.
All right, but if there's any other questions from folks, oh,
Got a question on, so Chase Creek was roughly 10-acre project. So 25 could be something pretty big and exciting. How many units do you think Huntsville can absorb in the next few years? I think there's still some runway there. I haven't seen an updated report for Q4, but the absorption rate is pretty favorable to us. Plus, this property is actually in a major thoroughfare. We're minutes away from the Toyota Mazda plant, which that's where all the suppliers are coming in. That's where the new Amazon distribution center is going in. So this property itself is actually in a very strong location of Huntsville. So we're excited about that. As far as units on there, I don't know, 25 acres is it's about double the current property. So I don't know. We may have to talk through that. It's still so early. We may have to talk through a phased development approach and maybe doing something creative there on the structure if we're going to develop it in tranches. But
the land was such a great deal. I would see us
Exactly.
wholesaling it off to like the developers. So if you guys, they build these things all over the place, right? Where they have a multifamily development, they might even have a hotel there, and they have your new upscale outdoor mall. This would be the type of land that they would use to build that. And then this is again right on that side of that Toyota Mazda plant. I think the last time we were in Huntsville, this is the place that we usually go out to dinner at around there. Are you guys looking to become an incredible accredited investors only outfit? I don't know, probably not. I still know all you guys. There's like about 350, 400 of you guys. Until I stop interacting with you guys, I'll probably keep it the same, but just get a little bit better on vetting investors, because some non-accredited investors just don't belong here, to be honest.
And frankly, even some accredited investors, maybe not. We've had issues with all types of investors. I think that's that's just a classification that the SEC looks at, and we've got to do certain things for each deal. So right now, I don't see that changing. If we do, we might get creative. There's a way that we could potentially do a 506c offering through what would be called a sub syndication and still allow non-accredited investors come in there. So that's a whole nother topic for another day, but that's another angle that we could take.
Yeah, I just see too many guys just going the 506c route where they just mass market to the general public. And I can see a lot of problems developing when they don't know their investors personally and they just cast that
Right.
wide net and fish for investors that way. And I don't want to go down that direction. Just another way I run my business, Kyle runs our business with smaller boutiques. We don't want this huge massive staff, just not in the lifestyle design. What is the final interest rate that we got for Whispering Oaks?
It was right at 3%.
So right
So
now,
right around 3 even, and that was 4 years interest only, I believe. I'm actually drawing a blank. I'd have to go back and check. It might have been 5, but it was at least 4%, or excuse me, 4 years interest only at 3%.
so Cambridge, we plugged in their 3.5%. Interest rates have ticked up, maybe a 10 or 2 higher, but probably would be around 3.25. But yeah, we usually try and underwrite a little bit more conservatively. That interest rate really doesn't matter, guys. When you play around with the spreadsheet, it's very small impact to the total return. It's just nothing compared to the reversion cap rate, what is full occupancy, escalators.
Yeah, it's just it where the rate comes in is one thing. It's mainly just where does it come in compared to the pro forma and the cash flow. That's what we're looking at. We don't really get too caught up. Is it 3.1 or is it 3.5? It's more about the cash flow and making sure that we have our assumptions in line. And generally, there's not a huge discrepancy. We try to aim high. That's why our current underwriting for Cambridge was at 3.5, just because we've seen a little bit of an uptick. But there's also they've come down a couple basis points. So it's a moving target until you close or you lock that rate. So we try to aim for the conservative side in our pro forma.
Yeah, and I think as you can see, some of these full cycle deals, like the returns are all over the place. Granted, to the good side, which is nice. But it's just we're here just to manage the deal the best way and make the right decisions at the right time. Sometimes it needs to be urgent decisions, monumental decisions, but A lot of times the money is made on the buy, and we
Yeah.
can verify that with the trailing 12 financials and where the property is ticking, and then just try and do a good, responsible comp analysis. And yeah, I like this type of investing. That's why most of my portfolios in this type of stuff. And I'm pretty bullish for year 2021. We'll see what happens when the stimulus money really
Yeah.
gets in there.
I am too, regardless of where the stimulus ends up, all political situations aside, too, if you just look at what's happening in our market, in the markets where we're invested in, that's what I mean. What's happening in Huntsville, what's happening in Houston, what's happening in Gulfport, these are still growing markets. There's the properties that we own are affordable properties, and that's our strategy, buying affordable properties where we can still see there's a value add play where we're raising rents, but we're not pricing ourselves out of the market. So we're not coming in and trying to charge a C class type of a resident $1,500 in rent. There's just a discrepancy there. So truly affordable housing is what we're after. And the Federal Reserve has already come out and said that rates are going to continue to stay relatively low. So what does that look like? I think it'll probably bounce between 3 and 4%. If it creeps up above 4, and then we're back to where we were when we bought some of these earlier deals. So that's why it's not a huge concern. It's just kind of where is it mathematically looking at, and we'll know rates typically when they increase, there's a steady increase. It's not just an overnight. It's not an overnight 100 basis point jump. So we should be able to see it happening, especially if we're in an active deal. Obviously, the deals that we're currently in, our rates are already locked, so we're protected there. But that's when it would really only matter is if we were in the middle of trying to close a deal and rates just spiked. So
yeah, check out my past podcast on John Burns. He gave the economy the green light. I was listening to ITR Economics yesterday, and they compared this with the 2008 Great Recession. They said the Great Recession, the engine was broken coming out of that, but now nothing's wrong with the engine. We just got to pre-prime the pump and get it going again. So they're calling for another 5-10 year bull run, the roaring 20s as they call it. But yeah, we'll see if it happens. If not, we'll just keep cash flowing and keep force appreciating the asset. And it may not be out of the question to see a few of these properties, the cap rate come down and we refinance it to take advantage of it.
Yeah, I think we're near the end, but I know we've talked about it. I'm sure you've seen it. We've got the Cambridge offering that's open right now. We should have PPMs ready to be signed tomorrow, but we're taking commitments there, and Lane sent out some links there. And then we've got some stuff in the pipeline, so stay tuned on that. I am curious before we run, I don't know, Lane, if you want to put a survey together. I'm just curious to get people's thoughts on this format, if they liked it, if they liked hearing what's going on in some of the other deals that maybe they're not invested in, or obviously the deals they are invested in, if they enjoyed this format or if we just completely missed the mark. But
yeah, let us know on the format, guys, because from our perspective, doing the monthly videos, if you notice, some of them have been not happening because quite frankly, there's not anything to talk about, and we never like to have meetings that can be sufficed with an email, and I don't think you guys would either. So that's why a lot of the deals that are stabilized and everything's clicking, we just send out a little bit of a quick rundown on the report. But yeah, maybe we do something like this every twice a year and do it in this efficient manner. We run through all properties. I think that's a pretty good, efficient use of everybody's time. But yeah, let us know.
One last question, Lane, that I saw, and this is a good question. When do you expect to send out K1s? So unless you are just completely against it, we always just say maybe plan to extend your return. This year was a little bit different, but I've extended my return for years now. I've never had any issues. In fact, my accountants like that better. But we do still try to have K1s out by mid-March is our goal. So that tends to fluctuate depending on how much back and forth we have. If we've got an active cost segregation study, that kind of delays pushing those out. So as far as preparation goes, I know most people probably like to be Johnny on the spot, but
yeah, we got a lot
to
of A
always extend that
students
out.
here. We have a lot of A
Yeah.
students here that always want to be on time, but the truth is taxes aren't really due until October, guys. You don't want to give the IRS an extra 6 months to audit you. You're not doing anything wrong anyway, but you don't want to give them the extra time. And you also want to, or like how Kyle's saying, you want to give your CPA time to actually do your return to write instead of just pumping it out in April. And then
but you do have to file for extension. You can't just not turn it in. You will get penalized. So make sure you file for that extension.
And then I'm sure there's going to be some tax changes coming. So it's always good to see what's happening to react this year. So that allows you to, see what's happening on the horizon and make changes, whatever you need to do. And by delaying your tax return as long as possible, you're able to make those long-term changes best. But thanks everybody for joining us. If you got questions on Cambridge, let me know. We'll kick that off this next week. And thanks for investing with us. And we'll see you in 2021.
Yeah, thank you. Happy New Year.
Bye, everybody.